everybody. Thank you for registering for your interest and the participation in our webinar, Financial Success Through Property Investment. I would like to introduce James Clark from Fidget Loan Specialists.
Hi, Uwe.
Hi, good to have you. Thank you.
Thank you for having me.
And there will not be many people that don't know me, but for the ones that don't, Uwe Jacobs from PropertyFriends. The way that we've structured it is that we do the presentation in two parts. I'll go first, talk about property investment, and James will then go second. And we have committed to be out in an hour, so let's see how we go with that. That will then depend how many questions we can answer. Straight and upfront, any question that is not being answered, we are only too happy. Send us an email. We're only too happy to answer every single question. Is that right, James?
Correct.
Excellent. So just apologies. I'm very intent on not making it too long. It is light, and we'll see how we go. Okay, so allow me to screen share and we'll get going. Okay, all right, so then let's get into it and let's see what we do. So first, of course, as always, we got to give you the disclaimer. We provide solutions for people aspiring to, that's actually not right. Anyways, the disclaimer, that's right. The information provided in this presentation is general in nature and does not take into account your specific circumstances. In other words, don't try to sue us. We never forget it's your money. So we all got to take responsibility for our own investments. Both James and I really have specific intent in assisting each and every one of our clients to learn more, to be better, to get better, so that we all can make better investments. Having said that, both James and I know what we're doing. Having said that, it is your money, so please do your own due diligence and your own research. Enough of that. All right, the agenda today. We really wanted to keep it simple, not basic, but simple. So we'll talk about the why, the how, the what, that's on the property side. Then I'll hand over to Marcus, to James. I'm sorry, I'm looking at you, Marcus, and I've got you on my mind. That's scary, eh? And then I hand over to James. He will talk about loans and the 5 secrets. And then I'll take over again. I'll tell a bit about why we're doing this and how it works for you guys, and really what next in the Q&A. So let's get into it. Why PropertyFriends? Well, we provide solutions for people aspiring to financial independence, choices in retirement, or leaving a legacy. Our proven system assists our clients through the intricacies of investments by having a safe and successful investment training system. And really, our pride and joy is seeing our clients grow their wealth and improve their lifestyle through our systems and methods. Now, when I say I take it back to basics, one of the reasons why I love property investment is very simple. Maslow's hierarchy of needs already said that we have different levels of needs that need to be fulfilled. Shelter and financial security is the second on the ladder. So it is pretty darn important to have shelter, and it is pretty darn important to be financially secure. As I'm sure everybody will know, We've just been through a pretty tough time. Why doesn't everybody do it themselves? Well, very simple. People are busy. I used to be a corporate manager, was doing 60, 70 hours a week, and knew I had to do something else. I just didn't have the time. So that is what James and I can offer you. Our expertise, we now can dedicate ourselves fully to these subjects. And that's a resource that can keep your time free. With whom and next? Yeah, okay. So let's talk about the how. Horses for courses is what I've got here. In my view, 96% of the market is doing it wrong. You go to a buyer's agent, you go to a sales agent and say to them, look, I want to buy an investment property. They look at their sales list. What have they got for sale at the moment? And then they go and say, hey, this is you. The best property that they have that fits your 10-minute discussion. In my view, that's wrong. We ought to start with where are we at? Where do you want to go? And then, and only then, can we develop the strategy for you to get there. See, our 7-step success system, I'm getting excited. That's when I start talking German. I better not do that now. Our 7-step success system provides accurate, unbiased investment guidance, training and opportunity, and we mitigate risk. We can do all sorts of things, but it should matter diddly squat what we can do. It should only matter what you want to achieve and how we can best help you to get there. So, yeah. Which one is for you? Well, that depends on where you're at and what we want to achieve. Our benchmark is very simple. Whatever you want to do, we will find the right deal for you. That's what you employ us to do. And our benchmark is very simple. Only the best will do. Only what Ulla and I, what is good enough for Ulla and myself, is good enough for our team. So, we've been doing it for 20 years. Okay, I admit we're all legends in our own mind, but I'd like to think we're doing pretty good deals. By the way, I'm just looking at James sitting there in his suit jacket. As you can tell, I'm sitting on the beach. I'm in far north Queensland, in Townsville at the moment, and I don't even blush when I'm wearing fibs. Of course, I'm not sitting on the beach, but it is still 27 degrees outside at 6:45 at night. So it is pretty, we got up to 37 today. It's pretty muggy and warm here. Suffice to say, I'm having fun. Okay, so that's the how. Now, I can talk about a lot, but really the issue is, what do we want to achieve? We can go for high cash flow, we can go for capital gain, we can go for a balance between high cash flow and capital gain, which is where I see most of the deals going, or what I call the out of reality stuff, where I go, this and this is the deal, and you go, really? That's why I call it the out of reality stuff. Gotta have a bit of fun. So, yeah. And again, all of that needs to be, as far as we're concerned, specifically fitting into where you're at and what you want to achieve. So everything else is just humbug. So let's spend a couple of minutes on how this works and why are our deals different. I've made a little calculation. I do that for fun. I'm a detailed person. I realize that is very hard to read, so I've summarized it. This is a deal that we're doing at the moment on the golf course in Townsville. And let me just cover that. Why do we invest interstate? I invest anywhere where the figures are good. Warren Buffett was the one that said, you can't manage money until you can manage your emotions. We are professional investors. I don't run a hobby. Hobbies cost money. Sorry if I'm tough, but that's the real world. And we find 3 to 5 spots per year where we choose to invest. Why only 3 to 5? Because quite frankly, that's all I can get into my head. And it is all about doing the research to provide the accurate, detailed data to be able to nudge the last $10,000 out for us. And when I say for us, Ulla and I are just part of the team. The only difference is we, as the PropertyFriends group and team, can muster up wholesale buying power. Now, it ain't rocket science. If you were to, hey, James, let me pick on you for a moment. Is that okay?
Sure.
If I was to come, if you were a car dealer, and I was to come to you and say, hey, James, it's your lucky day. I have 4 friends and we want to have not one 315i BMW, we want 5. Now, James, do you think you'll be doing something for us in regards to additional equipment, maybe an upgrade to the stereo?
If it's requested.
That would be entirely possible, wouldn't it?
Yeah, correct.
Okay. Do you think that for a set of 5, we would be able to get a bit of a discount?
Certainly.
Absolutely. And do you think you would be looking after a buying group of 5 a bit more than a single, if I come to you as a single purchaser?
Of course it would be.
Of course, it ain't rocket science.
No.
And it works. So this is the power of the leverage of PropertyFriends and also Fidget Loan Specialist. James is a broker for many different lenders, right? We both run the same system that we can take leverage and with that produce a better result for our clients. Anyway, so thank you, James, for that. I was talking about providing an example. This is a physical example of a deal that we're doing in Townsville at the moment. Why Townsville? Because it works, because the system works. So, and I warn you, this is blowing brain stuff. High cash flow and growth. We invest $50,000. The pre-tax cash flow, because of the very high rent that you're getting here, Townsville is under 1% rental vacancy. The pre-tax cash flow is $3,075 per year. Now, I do these calculations, and you can imagine there's 4 pages of details behind here, very, very accurately, as best as I can, because I do them for myself. I use 37% tax rate. That means that the after-tax cash flow is $5,372 in the first year. None of this, what I call feed the dragon stuff. I don't believe that a negative gear should really be done. Why do I say that? And I feel quite a lot of conviction with that. I say that because I don't want anybody in our team not to be able to go out to dinner, not to be able to have a holiday, because they got to pay $300, $400, $500 of their after-tax income into a property in the hope that it gets capital growth. I just don't think that is the right way to go. If you want to play the I get 37 cents in a dollar bet game, well, do me a favor. Give your money to me. I give you 30 cents, 37 cents in a dollar bet. And when I say it like that, it doesn't make sense, does it? So That's why we look for deals that pay at least for themselves completely. Sorry, I get excited about that stuff. I'm behind my product, behind what we're doing. So the after-tax cash flow is 37% or $5,300. That's more than $400 a month that goes into your pocket, not out of your pocket. Now, there are, of course, assumptions behind this, and I am happy to share all of these assumptions with you. I'm happy to share the calculation, the complete calculation with you. Send me an email, and I'll be happy to do that. At 7%, the sales value on completion, because we benchmark the market very well, we know what the market price is. And we know that the sales value is $550,000. So as a matter of fact, when we offset that against the loan of 456 and the investment that we've initially done, we add the positive cash flow. Your cash on cash return on investment about 8 to 12 months after you've entered the contract on completion is $48,409 or 9.7%. 97%. That is 97%, not 9.7, 97%. Call it 100%. Where can you get 100% cash on cash return? And I know that sounds crazy, but I invite you to shoot holes into my calculation. Many people have tried. No one has succeeded at this stage. Can I make a mistake? Of course, I'm human. Only the ones that don't make mistakes. But all due diligence has been done. And hey, the positive cash flow for the first 10 years is $65,000. Now, I don't know about you, but $65,000 make a difference to me. Anyway, I get off my high horse. Really, to be financially independent, we need to have more than one property. Now, not in the first year. This is a long-term game. So we've done many calculations. I've got many examples. This is a 10-year model, where after 10 years, you end up with $1,298,874 equity, roughly, and 13 properties. Now, from there, we pay back some debt, and you end up with actual equity in your pocket of about $1,923,492. Now, I can hear you say, well, anybody can develop these models. Well, we have helped several families to get an excess of $1 million in net assets. Our return rate of clients is 76%. That's crazy stuff. And we like it that way because it means that we have happy clients, satisfied clients. It means that our system works. So here are two families. I've changed the names because privacy is very important to me. I think we should at all times keep the privacy where it belongs, and that is private. And the people that have done these deals know who they are. So here's two examples. In this case, N&J Smith. The names are made up, but the deals are correct. Between September 2003 and July 2006, in less than 3 years, they got to $309,500 in equity increase. This is a family group, parents and adult children. chose to go together in between September 2005 and January 2007. So in, what's that, 18 months, $602,000. Now they bought 7 properties. Yes, I grant that. But that's $90,000 worth of capital gains per property, or 600,000 in 18 months. That is great money. And that's the sort of deals that we do. Now, or we can go for the quality qualified investment, which is a very special deal. And, you know, the return is 8% net. These have 20-year government-backed lease. They're new properties, extremely low rental vacancy. They're sought-after properties. And I've got a spelling mistake in here, with rental reviews annually. And because we put them into strategic, desirable locations, there's also capital growth. How much capital growth? Well, nobody can guarantee that. Nobody can forecast that other than going by the best of what history tells us and add the identifiers and the pointers to that forecast. So, you know, we expect good capital growth in these cities. Okay. The what? We suggest, generally speaking, to go for a balance between growth and yield. The reason is, again, I go back to our system. Our 7-step success system is providing accurate and unbiased investment guidance, training and opportunity, and we mitigate risk. Mitigating risk means that we want to have a property that pays for itself. The investment guidance is given by, we have about every 3 to 4 months a championing meeting. I'm very available and approachable. And the accurate and unbiased data we provide when we give you the information about the deal. We talk through the deal beforehand, and you'll have enough time for your research. So we like to train and provide the opportunities and keep it low risk. I think that's very important. That's why you need a balance between yield and growth. The yield is the short-term money, your rental income, and we need that to be high enough to have the deal completely paid for by itself. And the growth is simply what we call the big money. That's your capital gains. That's where the real money is made. Really, to get financially successful, you need to, it is advisable, it is good to have more than 3 properties in the strategy. 1 is good, 2 is better, 3 is best. Really, from 3 property onwards, you will find a very distinctive and lasting impact in your lifestyle whenever you want to retire. And there is certainly a risk-reward continuum. We like to keep it very, very risk-averse because, and again, go to Warren Buffett. Return off my money is more important than return on my money. I don't know about you, I'm not a young whippersnapper anymore like James. I have lots of grey hair, and I wouldn't want to lose $300,000-400,000 in a big loss situation. It's just not my game. So return off your money is more important than return on your money. Anyway, James, over to you.
Thanks, Uwe. I really appreciate the opportunity to be presenting at this webinar. So I really thank you for that. I'm a bit jealous that you're enjoying the beach or the nice weather while I'm in Melbourne and it's cold and wet. But that's all right. We'll get there one day. So for the people that are on the call, my name's James Clark and I'm from Fidget Loan Specialist. Now, as you can see on the screen, I'm actually a mortgage broker, as Uwe has already said as well. What I'm going to outline for you is who is Fidget, our services, 5 ways or secrets to secure your finance, why to use us as Fidget, and eventually show you my contact details. So please contact us. Who is Fidget? Fidget are a team of full service mortgage brokers. We hold strong relationships with most majority of lenders. So we have over 40 lenders that we can actually take loans to. Yes, we do have our favorites, but at the end of the day, based on your situation, on what you're looking to do, we'll provide you with the best deal, with the best lender, based on the parameters of customer service, online capabilities, and at the end of the day, the best rates. So we will understand your situation and can help you navigate through sometimes the complex lending landscapes when it comes to things like lender's mortgage insurance, principal and interest only. We can help navigate you through those different complexities. Okay. Our services. So we have a range of services. Probably my most and favorite one is dealing with first home buyers or upgraders. The next one would be first time investors, and then other people looking to invest in property multiple times, and then providing home loan health checks. So looking through the guides of finance, refinancing your home loan for a better deal. The main reason why I'm actually talking today is 5 ways to secure your finance, or 5 secrets. Point number 1, 3 main criteria points every broker needs, right, is security, serviceability, and funds to complete the transaction, right? So starting off with security, a lender will need to be happy with the property that you are actually buying. So when I say actually happy with that property is, 1, if you're building, they need to take a look into the building contract as well as a land contract, obviously and evaluate the property as a complete valuation. They'll need to take into account the different segments, being market segments. So where is the property at in the market, the land, the environmental issues, as well as the improvements, and then the location of the property. So what sort of neighborhood is it in, and then also the last thing being the market activity. So as Uwe was saying, is that low vacancy, that's definitely something that's taken into account and helps with the valuation of what your rental return would be on that particular property. Serviceability. This here is probably mainly one of the key points of what a lender will look at. A borrower needs to pass the servicing capabilities. So in principle, this is a logical process. A lender will look at the applicant's income after tax and then deduct any living expenses, such as living expenses and other liabilities, being car loans, personal loans, and credit cards. Mind you, with credit cards, just as the thing that I wanted to point out with that, is lenders will always take 2 or 3% of the limit on the card. So they'll always assume that that card has been maxed out. So this is taken into account your affordability. But when you're talking about investing, the good thing is that lenders will take into account the rental return that you're receiving. So one outweighs the other. So at the end of the day, the serviceability, as important as it is, it's always great to take that into account, the rental return, because that will pay for that. And in that way, the banks will be happy to lend you the money at the end of the day. So always ensure that you're including that rent. So make sure that you've got your broker doing that for you. The other good news that I would like to announce, legislation, they're trying to pass this through, but taking responsible lending into account. So then when they look at living expenses, it's cross-reference with your bank statements, but taking into account a logical thought process. Everyone can't eat tuna out of a can, but then again, no one can eat Wagyu and Shiraz every night. So obviously, depending on your lifestyle, they'll take a conservative approach to that. So if you're going to budget yourself going forward, your broker will help you navigate that and explain that to the bank. So always get a good broker on your side. The last bit, funds to complete. Funds to complete is paramount to you obviously providing or getting finance. This is where the bank will look at how is this borrower going to be completing the transaction of actually borrowing the money. So no lender will actually lend you 100% of what the property is worth. They'll always lend you up to 95%, some cases 90%, but that depends on the lender's policy. This is where lender's mortgage insurance comes into play. For those who don't know what lender's mortgage insurance, I'm more than happy to go through that at another time. But basically, it's an insurance premium that covers the bank should a shortfall occur in the event of repossession or sale of the property. Now, funds to complete, that can come from multiple ways, be equity release or cash savings, and which leads me into the second point, equity release or cash savings. So as Uwe was saying before, that from a simple investment of around about 50,000, some people it's simple, but it being a $50,000 investment for your property, right? That can come from another way, a number of ways, being from hard cash savings that you've saved over the years, right? Could also come from a gift that you receive from family or an inheritance. But the other part is an equity release. So if you currently own a property, based on our calculations and our research, depending on how much equity you've got in your property, we can use that to release that and then pay for this other property that you're looking to buy potentially, right? So that, excuse me, using your current equity in your current property, if it's available, to use that towards purchasing this next property. Loan structure. I wanted to touch base on loan structure simply because there's a number of ways that you can actually structure your loan going forward. I will say the same as what Uwe said at the start of this presentation, check with your accountant or financial advisor in that sense. We can just we can tell you all the types of loans. So what I was saying is that we can tell you all the types of loans that are available, but whether good financial advice is going to be there in terms of tax deductions and what's going to be good going forward, always touch base with your accountant.
Yeah, look, I just wanted to let you all know, I've just put a message into the chat system. We are happy, very happy to take questions, and seeing that we're a nice small group, when James is finished with his section, what we'll do is we can all if you want to, turn your video camera on. I'll switch everybody through on and take you off mute, and then we can have a live discussion. Why not? It's a nice small group, and that is where we can really help and answer questions, answer issues. There is no such thing as a stupid question as far as I'm concerned. I'm sure James is on the same boat. The only stupid question is the question that's not being asked. So feel free to come up with anything, to ask anything. You're right, James?
Oh, a stupid question is how did I get something in my throat? Thanks for that. Sorry.
I don't know. I can't answer that.
No one can, not even me. But where was I? Loan structure. So interest only is only advised when you have a high non-tax deductible loan, so that you can concentrate on paying down your own non-taxable debt, i.e. your owner-occupied property. But this would mean that you're giving most of your equity up to the bank, so essentially you're not paying any of the principal component down. So once again, touch base with your financial advisor, as well as your trusted advisor being a mortgage broker, to help navigate you through those things, because we can show you what's going to be best off when you're looking at your investments, and then also your non-taxable debt, right? Interest only makes it only affordability tighter. So being that, yes, we can take rental income into account, it only makes it a little bit tighter. So at the end of the day, a broker will always help you navigate through those things of serviceability. So make sure he's on top of that. With an offset or without an offset, this is dependent on what sort of income stream you've got. Obviously, with an offset, you're offsetting against the interest against the property or the home loan itself. Without you, obviously, we would suggest that we wouldn't get you an offset, because it does incur an annual fee at the end of the day to have that offset. Yes, it can be good in minimizing that interest component, but you've got to have a certain amount in that offset to be offsetting well enough against the interest. For example, an offset will cost you $395 per year. So that's $395. By calculations of 1%, you need to have at least a minimum of $10,000 in there to offset just that $400. So that's something that you'd need to take into account and have a chat with your broker regarding that. I've touched on principal and interest only. At the end of the day, my advice is, depending on your financial position, right, look at both avenues, whether P&I, principal and interest, is going to be good for you going forward. But remember, that pays the debt down, whereas interest only doesn't. Interest only pays the component for the interest. The next thing is, everyone's talking about these low rates. Rates are certainly low given the circumstances that we've just been through. Fixed rates on owner-occupied properties, you'll see on, the news or the Today Show at 8 a.m. that rates are low at 1.87. Unfortunately, that is not the same for investment loans. So happy to report, although still low, rates are starting around about that 2.29 for fixed rates, all the way up to 2.69 for fixed rates again, and that can be a minimum or a maximum of over 1 to 5 years. Obviously, every lender are going to offer different rates, but based on your parameters, your broker will be able to provide you with a good outcome. My top tips for borrowing funds: 1, definitely have a stable job and a regular income. At the end of the day, you need to show the bank that you've got affordability there and you've got capability of paying the funds should you not have a tenant in your investment properties, right? Have a stable address. The bank want to know that you're a stable buyer, so not moving around too much. Can't keep an address, can't keep a job. Have a stable sort of, I guess, not lifestyle, but address at the end of the day, or career. So then that way the bank can see that you're less of a risk. Showing that you're financially responsible for making regular deposits in savings accounts. So whether it's $100 or $1,000, making regular deposits into your savings account shows the bank what type of borrower you are. So it builds up that profile, and your broker will be able to help provide a good profile to your bank based on all your statements, based on all the questions that he will ask you about your financial status. And then the next one is paying bills on time to avoid bad credit ratings. These days with your credit rating, a lot of banks are looking into things like mobile payments. So mobile phone payments, utility payments, even your car payments, of course. And then again, with your credit cards, make sure you're paying your bills on time to avoid bad credit. Don't overdraw at all on your credit card. So if you max them out, don't max them out to the single cent. Don't go overboard that, because the banks can actually see that on your bank statements. Nowadays, a lot of lenders want to see these. When you're investing, joint with someone that you know and trust, i.e. your spouse. The lower the LVR that you've got, so the more deposit that you can put down, obviously lenders take less risk. So that's what they're definitely looking at. And then the last thing would be common sense is the key. Whether or not you can afford it, obviously you're the ultimate person that can make that decision if you wanted to take that risk. But we're saying that we'll be able to help you out with that. And with the help with Uwe that can help you with that investment, you're definitely in good hands. Why use Fidget? So Fidget will keep you informed directly. We're frequent and we're transparent with all our clients. At the end of the day, we've got a portal that we go through, and the client can actually have access to that. They can find out and see where their file is at, but we're going to keep you informed via phone or email at the end of the day. So you're never in that guessing game of going, where is my finance at? Am I approved yet? What did he do last? I haven't heard from him. You'll be able to see all those things and be informed by us. Flexibility. We provide flexibility in how we work with you with multiple locations for meetings. Nowadays, a lot of people, with what's happened in recent times, we can actually come out to you now. Now, given obviously we're in the state of Victoria, we'll be able to help out in that sense. The next one being a very high loan acceptance rate. So what this means is that we look at every avenue to ensure that we give ourselves the best chance of being approved. So that's everything from checking serviceability, checking lender policy, checking the profile, checking all the requirements that the lenders will need. We make sure that we tick every box before we submit it for an approval, because at the end of the day, we don't want to throw something up against the wall hoping that it sticks. We want to make sure that it will and that you get approval, right? So we have over a 95% approval rating. There's only been instances where we haven't gotten approval, where someone hasn't told us about something and they're actually doing something wrong with that particular debt. Oh yeah, credit card. People forget about credit cards, like credit cards that they purchased Harvey Norman store goods. They forgot about that credit card, but it was outstanding. But some people, but they haven't looked after those payments. There's some instances in that sense, but some lenders, they like to have all information disclosed to them. In terms of, we're an independent broker, so we don't charge you any fees for our service. We'll supply you with the additional information that you need. And basically, we're good and honest people, so you can trust us. And you'll be able to see all our Google reviews and things like that of the experiences that other people have had.
And by the way, James wouldn't be here if he wasn't trustworthy.
Thanks, Uwe. So lastly, if anyone wants to get in touch with me, you can see my details on the screen. I do have a QR code there that will take you straight to my Facebook page. Thanks, Uwe. Over to you.
All right. I'm getting a number of great questions. Yeah, look, it's fun. Keep them coming. What I would suggest is we are a small type group. So whoever wants to put on their video, feel free to do so. If you don't, that's fine. I will ask everybody to unmute. And if you want to, by all means, speak up. Rebecca, I can't see that you have or the person that is stated as Rebecca, that you have a microphone, so you may have to, that's Ravi. No, Ravi has got a microphone. Rebecca, you may have to use the chat. Well, this is great. I'm really enjoying that. Sridhar, if you want to, you are unmuted. No, you're muted at the moment.
I think I'm unmuted too.
Okay, fantastic. All right. Look, guys, I'm really, really happy. James, we've got some doozies of questions. We'll be busy. Okay, let's go to the first one. So this is from Marcus, was the first of the rank. Now, yes, hang on. Marcus asked the question, let's say we buy 5 properties in Queensland. What entities would you buy them in? For starters, Marcus, my answer to that is I would buy them in different towns for risk mitigation purposes. I would put them in 1 or 2, probably. If you go for 5, I would go for 1 or 2 in company and trust. The reason is in Queensland, trust under a different head company, the land tax does not get aggregated. Generally speaking, and you've been in the game for quite a while as well, Marcus, we don't put, personally, I don't put that much essence or emphasis on companies and trust anymore. The reason is that more often than not, people find it hard to offset the non-cash deductions that are ring-fenced in the trust with good profits in another trust. Does that make sense, Marcus?
It does.
So I see a lot of people that got, forgive me for my French, flogged the company and trust, and they are now sitting with properties in company and trust and could dearly do with the tax deductions. And really the threat of being sued is there, is real. It has happened to us, to Ulla and myself twice now. In 20 years, I hope we're good now for the next 20 years, but we'll see what happens. The risk is real, but I'm not a surgeon. I don't consider myself in a high risk area. So lately, Ulla and I put properties in our personal names, simply because it's easier to run the tax. You don't have the compliance cost. I call it $1,500 to $2,000 per company in trust, and it all adds up. In our case, we're past 10 trusts, and I chunder when I get my accountant's invoice. Does that answer your question, Marcus?
In a way, if you put them, it's a hard mix because the land tax is a bit of a killer, and it also creeps up every second year. They just go, here's some more.
Yes,
it's a step rate, so you might not have any, but then you will, and then it'll get significant very quickly.
Yes,
but yeah, the trust you don't get to get your tax breaks. They get deferred, if you like.
Correct. If you want to pay the land tax game, what we do is we don't put 5 in Queensland together in one company, say in 2 or 3 trusts. We put 1 Western Australian, 1 Queensland in one trust under one company.
That makes sense.
New South Wales and the Queensland one under a different trust in one company. If I play the trust game, I don't put more than 2, maximum 3 properties into one trust. Because if you're serious about ring fencing the risk, if you do it for risk mitigation purposes, well, 3 properties, call it at 500,000, 1.5 M is for me enough risk. But by putting different states into one trust under one company, you mitigate the land tax. That's the best tip I can give you when you want to put a company in trust.
That fits.
Mm-hmm. Okay, so then we had a question from Ravi. What is better? What is the better option for an investment loan, either to go with P&I or interest only? That's probably a question for James, but allow me to ask give a couple of my thoughts to that. Generally, we describe the property game we break it down into 3 phases. The first is the accumulation phase. He or she who accumulates the most properties in the shortest time wins. The second is the consolidation phase, where you simply sit on the properties, and because they don't cost you any money, you're safe. You sit on the properties, wait for the capital appreciation, and then you can get to phase 3, which is the repatriation phase, where you then sell part of the properties off, and you're sitting on the beautiful capital gains that should carry you to retirement. Now, in order to go for the accumulation phase, remember that it was he or she who accumulates most properties in the shortest of time, cash flow is very important. It makes a hell of a difference in the accumulation phase whether I have to pay principal or not. We calculate and we set up all of our investment properties with interest only, because I want to have buffers. I want to have the maximum lending accessibility. Now, our Private family home, our principal place of residence, different story. Principal and interest, pay the sucker down as fast as you can. That would be my explanation. James, over to you.
That last comment, that's exactly what I would say. The only reason why you would go interest only, well, there's a couple of reasons why, and Uwe's already said that, but mainly is because you free up cash flow to pay your own occupied debt down as quick as you can, because that is not tax deductible income, right? So that's the main point why you do interest only. But at the end of the day as well, when you're looking at interest only, you're building up the equity in your property, right? But you're mainly paying your own occupied debt down as quick as you can. That's the whole goal, the end game for that. Pay it down as quick as you can. And as Uwe said, pay that sucker down.
Okay, we're already at the 1 hour mark, so I want to keep it going. Remember, feel free to send emails. Actually, can I get you, Lenny, to put both James's and my email into the chat box, please? So you'll find our email contact addresses in the chat. You also see that James has got a 3D barcode. He's really typical young'uns. They are up with technology. I had starting my computer.
I believe we've got another question there as well, if I can. Drew one, how often can we change the lenders once you refinance your home with one lender? The answer is it depends on what sort of loan you're in. If you're in a fixed phase, I wouldn't refinance it simply because you're going to break costs. So you're going to incur those costs. But reality is when you're in a variable state with a variable phase with a lender, you can refinance it as many times as you like. Obviously, you've got to take into account the many fees that you could pay, i.e. discharge costs, and then another mortgage registration fee. They're usually the charge of $120 each time. So you'll pay $120 at the start, $120 at the end. And that's the same thing with refinancing. If you do that and then end it again, you're going to be paying that discharge fee, right? But the reality is that on a good note, I reckon reviewing your home loan, and this is what we would do, review it. This is what we do, sorry. We review it every 12 months just to see what sort of deals are out there on the market, making sure that you're getting the best value for money for your loan, right? That's what we do as a company. We annually review your home loan. So that's what we call a home loan health check. All right. That's just my 2 cents in when it comes to financing.
That makes perfect sense. Sridhar had also, actually Ravi was before. Ravi, what's the better option for an investment loan? Are we for that? Sorry. Sridhar, does a 10-year plan assume you invest 50,000 on average every year, or by leveraging the equity you build on your investment properties? Sridhar, that is the personal challenge that I have set myself. I've said that the accumulation phase, whoever gets there the fastest with the biggest amount of properties, depends on your strategy. I always say that. It depends on your strategy. But with the first investment, it needs to be funded out of your own funds, be that equity, be that whatever. From then on, if we do things right, we should be able to leverage from the equity gains out of the first property. Now, let's say, for argument's sake, that you've got 10% capital gains. Let's say that it's a $500,000 property, because it makes my math easy. After 2 years, I have 100,000, and I should be able to do a redraw on that at 80%. That means I've got 80,000. So I'll give and take a bit more savings, and after 2 years, I can buy another property. Do you agree with that, Sridhar?
All right, yeah, got you.
Okay, so now fast forward 2 years again. Now we haven't made 100,000, we've made 200,000. And this is how the game accumulates. If I go back to, let me just, this is how, let me just do this. This is how this works. You see, when you look in the value at the start, we start off in year 1 with the first property.
Okay.
Right? In year 2, we still only have 1 property. At the end of year 2, we're withdrawing, that's the one that's minus 100,000, number 2.
Oh, okay.
So every time when we've got enough equity in the portfolio by now, we withdraw equity and buy another property. Now that means that you need to be diligent and need to have your plan together and be prepared to follow your plan.
Yeah.
I have a wife that is really, really supportive.
Mm-hmm.
She was driving an 18-year-old car. I don't know about you, but I have these well-meaning friends that said, buy your wife a good car. Now, every time when we had $80,000, I went to Ulla and I said, sweetie, do you want to have a new car or can we buy another property? Well, the good lady that she is, she supported me and supported our cause. And for 10 years, she waited for a car. And then you have these people that say, oh, this stuff doesn't work. You know what I say to them, Frida? Don't tell my wife we bought $150,000 Beamer cash. You know, I don't know what's your hot button. I don't know what you want to do, but the stuff works because it's a system. It's not me, it's a system. And that system has been proven many times over. There is a reason why we have got people that have been with us for 10, 15, 18 years. There is a reason why we have people that come back. 76% of people come back time and time again. Our system works. Anyway, I get carried away.
All right.
Does it answer your question?
Yeah, perfectly, Uwe. Thank you.
Thank you. Marcus again, responsible lending has been relaxed. Do we have low doc equity loans or more flexible products coming? James, that's over to you.
Short answer to that is no, not just yet. That's the short answer. But at the end of the day, I'm assuming lenders are going to take a responsible approach to it. However, yeah, not yet, unfortunately.
It's a pity.
It certainly is, because it would be easy to get a loan with low docs, but then again, you've got to look at the interest rates and returns, obviously. But at the end of the day, a good broker will be able to help you navigate through those things, as I've said before. But just not at this stage.
I mean, I would love it. I had a lot of fun, Frida. No, who was it? Marcus? Marcus.
Yeah.
I had a lot of fun going to the tax accountant saying, mate, I need a letter. This year. That was a lot of fun. It was also downright dangerous for the people that will, as I call it, leaning too far out of the window. They were over-gearing. And when the interest rates were up, they were in trouble.
Yeah, but only if the prices go down, you just sell.
Yeah, well, that's true.
They bought in mining towns, and then they said, "Oh, it's not fair."
Yeah, yeah. And this is why I'm always pushing the point. Where are we at? What do we want to do? You know, what do we want to achieve? Yeah. Anyway. Okay. What if the principal place of residence is paid off? James, what would you suggest if the principal place of residence is paid off? Do principal and interest or Do just PI.
Oh, dude. Well, at the end of the day, it depends on your parameters of your financial position, right? The reason why I would do principal and interest is because you're paying it down as quick as you can to build up more equity, right? So the quicker that you do that, the quicker that you reinvest that money to release that equity and then go purchase another investment. So as we were showing in the numbers before, 1 year, then year 2, but then year 3, or at the end of year 2 is when you pull out that equity. You get there much sooner, pulling out that equity. Interest only is only good when you want to maximize cash flow for other things. If you want to take that extra cash that you would pay for principal and interest, put that in a separate account, you're not doing it the right way, because at the end of the day, you're building up that equity. So it's the same thing essentially, right? Building up that equity to quickly release that to purchase to reinvest it into another property. Plus, if it's paid off, you're doing quite well, right? You've then done the goal of paying off your non-tax deductible debt as quick as you can. So that is part of the dream at the end of the day. But it's better to go principal and interest because you build up that equity, release that as soon as you can, rather than the wait game of building up your equity to release that for later purchases. Do you have a different opinion on that?
Ravi actually has left, I think. Anyway, doesn't matter. It's a good question, and my short answer to that is, if you have your principal place of residence paid off, we know a better time to buy another property investment. And yes, I'm biased, but why would I have, let's say, my principal place of residence is 500,000? That means I can borrow 400,000. Well, with 4, my equity gains are 4 times as much. So this is why it's so important to minimize expenses, maximize the capital growth on the premise that the running of the property doesn't cost you any money. Because that's the nirvana. If I can sit there and have my life going as it was going before, my property investments are rising in value, but I don't need to contribute anything to it. Now, what happens if we have a situation like we had in Sydney, 7 years no growth, and let's do the comparison, Cairns, 5 years no growth? What's the difference? Well, in Sydney, you were paying between $700 and $1,000 per month of your after-tax income. I don't know about you, but after 5 years, my wife would have killed me. She would have said, what are you doing? We've paid 5 years, $700 times 12 into this house. Our lifestyle is diminished and nothing has happened. And then guys like me hold out for another year and 6 years, and she's nearly ready to kill me. And then I finally give in and I sell. And blow me down, the next 3 years, the sucker goes up 80%. But you don't know when that happens. It is going to happen, but you don't know when. So I'm saying, let's be risk averse and find places to invest in. And this is the reason why we go Australia-wide. I go wherever the formula works. Let's find places where we have little to no risk. Let's be risk averse. Now, compare that with Cairns. Cairns pays for itself completely. Now I sit for 6 years and nothing happens, and I go, big deal. Yes, I would like the capital growth rather today than tomorrow, but I don't have to fork out $500,000, $700,000 a month. That's the method of my madness. I don't want anybody to have to reduce their lifestyle. I don't want anybody, when somebody gets pregnant, usually it's the wife. That's a joke, and they don't get any better. Sorry, I just couldn't help myself. You're getting too serious on me. when one gets pregnant, the expenses go up. I don't want to be anyone in our team to be in a situation where, because of a kid, which is a great occasion, which is lovely, but now we can't go on holiday anymore. We can't go out for a cinema once a week anymore. We can't go out for dinner anymore because we got to feed the dragon. That doesn't make sense. So sorry, I get carried away with that stuff. I apologize. All right, last round. Any more questions? Rebecca, if you have anything, put it in the chat box, please.
We do have one last one there. What about the serviceability? Ruad, can I just get you to just a bit more context behind that one?
You can speak, Ruan.
Yeah. Can you hear me?
Yeah, absolutely.
I mean, I just, who knows, I just did my refinancing for some of my properties, and my broker was always talking about serviceability, how much income, how much expenses, blah, blah. So he said, I'm maxed. So I'm not sure whether that is true or not, because when he looked at my properties, I'm not trying to criticize anyone here. I mean, just to see where I am, he didn't even look at one of my properties. He said, leave that aside. I said, oh, that's a bit weird. That's all right. We started the process. We went ahead and get 2 properties refinanced. One property, which is highly, Uwe has helped me on that property. He's the guy who did that property with me.
Yeah.
And it's got a lot of capital gain. And he said, I'm maxed with serviceability. So I'm a bit lost. I don't know.
I'm trying to think of ways of why would he say that? It depends on
the reason that he didn't touch that property.
Yep, sorry.
The reason that he didn't touch that property is that if you show that property into the refinance situation, they will not refinance you with another bank. I said, all right, leave it then. Let's go ahead with what your plan, how the plan works, and I stick with it.
Yeah.
Went through it, just settled it. That's fine. I'm not unhappy about it, but I just want to dig deep and see what this is all about.
Yeah.
I just put a bit of context around that. Rowan, I hope you don't mind. I should ask.
Yeah, go ahead. Yeah, you know.
Is it okay if I disclose the amount of capital gain that you've got in that property?
Yeah.
Okay. So we're talking about $150,000, James,
Right.
that have not been taken into account
Yeah.
of capital gain. And I'm sorry, I go, what?
Yeah. I'm sort of doing the same thing as well, but in my head. Do you trust your broker?
I did trust him. Did.
You did.
I did.
That's the question.
No, I have doubts now. I have spoken to about it openly. I said, oh.
Yeah. Look, at the end of the day, all I can say is that getting a second opinion, you'll do that if you go to the doctor, right? So if you needed something from the doctor, you will get a second opinion. All I can say is at the end of the day, if there's a little bit of doubt, even that small little doubt, have a chat to another broker for a second opinion, right?
I didn't do that. That's okay. I'm happy to sit around for another 6 months and see. That's the question. That's why I put the question up saying.
Because every lender treats things differently, right? And that's what's good about it, using a broker, is because we've got access to over multiple lenders. Every lender does things differently and calculate things differently, and then also take into account things differently. But that's where it comes down, that you need a good broker, right? And it also comes down to you need to trust your broker as well. But getting that second opinion is never a bad thing at the end of the day. All I can think of is that he's not looking at other avenues on how to structure your loans that will get you the benefit that you're looking for, right? Because it is also to do with loan structure as well. Taking into account the rental income that pays for one or the other. Some lenders, they only take 80% of the rental income. Some lenders take 100%, right? He's got to look at those different avenues. That's the only thing that I can think of. Living expenses, they are what they are, right? But the amount that the banks are taking, and it comes down to lender policy. So get a good broker behind you.
Anyway, I'll wait for another 6 months. We just did something. I was speaking to about it, and I think he mentioned that maybe it's about you. I'm not sure which. He was talking to the team,
So for
and I
instance,
said, yeah,
so
let's
for
look at
instance,
it.
just looking at lender policy, Commonwealth Bank, they'll take into account 80% of the rental income, right? Liberty, yes, they are a higher rate lender, but they take 100% of the rental payments. So that's just the difference in terms of the lender policy. So just get him to be checking that for you. Otherwise, get a second opinion. Not that I'm trying to persuade you.
I understand.
You'll do the same thing with if anyone would do the same thing if they go into a doctor.
Yeah.
But yeah. Thanks for the question. Awesome.
No worries. Thanks for the answers. Appreciate it. Thanks.
Yeah, look, that's to me, the benchmark is exactly that. Both James and I need to be able to stand up to scrutiny. Otherwise, why would you use us? All right, guys, we are now on 15, and it's 9:45 at your end. I've got an hour up on you. It's 7:45 here in Queensland.
Oh, another thing to be jealous of. I need more time in the day, Uwe.
Well, as you can see, the beach behind me looks dry. I need to go for a swim.
I enjoy. Well, thank you very much again for having me. I really appreciate it.
Yeah, look, that is an absolute pleasure. I trust that was fun for you guys. I trust it has given you information. I will send the recording around to everybody that has participated. Feel free to get back to us with further questions. And both James and I have committed to be making a minimum of half an hour available for anybody who wants to have a laser focus session where we can then talk individually. It is very hard to, go into individual circumstances. So feel free to take advantage of that. On the PropertyFriends website, there is at the bottom of the website a calendar booking. I just simply want to avoid the telephone ping pong. Book yourself in for half an hour. It's free, no cost, no obligation. And I think we have both shown that we know a thing or two about our areas. Same thing with James. You can either email him at james@fidget.com.au, or if you're a young buck and up with technology, or if you're up with technology, that is, I should say, scan the 3D barcode and you get through to James's Facebook page. Thanks very much from my end. That was fun. If you liked it, tell your friends. If you didn't like it, tell us.
Thanks.
We will put these on now monthly with different subject matters. So I hope that helped. Enjoy. Have a good one.
Thank you.
Bye-bye.